Picture this. You wake up one morning, maybe it's a Tuesday, maybe it's some random Wednesday in March, and before you've even had your first sip of coffee, your phone is already buzzing. The headlines are screaming. Markets in free fall. Billions wiped out overnight. Investors panic as stocks plunge. And you're just sitting there, still half asleep, and this quiet dread starts creeping in because you have something in the market. Maybe it's your 401k. Maybe it's a small brokerage account you opened 2 years ago because everyone kept saying you should start investing. Maybe it's just a retirement fund you barely look at, but you know it's there. And then you check the number, and it's down. $1,000, $5,000, $10,000, just gone. Or at least that's what it feels like. Hi, I'm Mike, and welcome back to Wealth Vault. Here's the question I want to ask you today, the one most people never stop long enough to really think about. And it's the question that changes everything once you sit with it. Where did that money actually go? Because it had to go somewhere, right? $1 trillion doesn't just fall into a hole in the ground. Wealth doesn't just evaporate into thin air. So what actually happens? Who ends up with it? And should you even be panicking right now, or is something else going on entirely? The answer is both simpler and stranger than most people expect. And once you understand it, the panic, the dread, the urge to pull everything out, it genuinely starts to feel different. So let's talk about it. Here's what almost nobody explains honestly. When people hear the market lost $2 trillion last week, they picture a vault somewhere filled with cash and someone just emptied it, like money physically moved from your pocket into someone else's. And with that image in your head, panic makes total sense. If someone took your money, you'd want to run. You'd want to protect yourself. You'd want to get it back. But that's not what happened. That's not even close to what happened. And I don't say that to make you feel foolish, because this is genuinely counterintuitive. The financial world does a terrible job of explaining it clearly. Our brains are wired to think about money as something physical, something you can hold, something that if it disappears, must have gone somewhere. But the stock market runs on a completely different kind of logic. A logic that, once you understand it, stops being terrifying and starts becoming something you can actually work with.
So let me walk you through what's really going on. Not in a textbook way, but in a real, human, let's actually think about this together kind of way. Let's start with the most important idea, and I promise to keep it simple. Stock prices are not a measure of how much money exists in the world. They're a measure of what people believe something is worth at any given moment. Think about your house for a second. If you bought it for $300,000 and then the housing market dips and your neighbor's identical house sells for $250,000, your house didn't lose $50,000 in cash. The perceived value changed. The actual walls, the roof, the kitchen, they're all still there. What changed was the collective agreement about what it's worth right now. The stock market works the exact same way. When you buy a share of a company for $100, you're not depositing that money into the company the way you would with a savings account. You're buying a tiny slice of ownership. And the price of that slice? It's basically a collective agreement. Millions of people, institutions, and algorithms all trading, all signaling what they believe that share is worth today. When a crash happens, what's actually collapsing is that collective agreement. Suddenly, enough people believe those shares are worth less, maybe because of fear, maybe because of bad economic data, maybe because of something nobody saw coming, and the price drops. And when the price drops, the calculated value of your portfolio drops with it. But here's what's wild, and this is the part most people genuinely don't realize. Most of that money was never really there in the form of spendable cash in the first place. It was paper wealth. Value on paper, or really just a number on a screen that represents what your shares could theoretically be sold for at that exact moment. So when we say $2 trillion was wiped out, what we mostly mean is this. $2 trillion worth of paper value stopped being agreed upon. The collective belief shifted, and so the number shifted. It didn't fly into a billionaire's offshore account. It didn't get transferred somewhere and hidden away. Most of it simply stopped being agreed upon. The belief changed. Now, that said, it's not entirely a ghost story. Because some real money does change hands during a crash, and this is where it gets genuinely interesting. When prices are falling fast, there are always two kinds of people in the market at the same time: the people selling in panic and the people buying. If you sell your shares while the market is crashing, you're locking in your loss. That part is real. Your paper loss becomes a permanent cash loss. And the person on the other side of that trade? They just bought your shares for less than you paid. They didn't steal your money exactly, but they did acquire a valuable asset at a discount. And when the market recovers, they benefit enormously. That's why you'll often hear that market crashes are the moments when generational wealth is either lost or built. The same event, two completely different outcomes, depending entirely on what you do. There's also another player most people don't think about: short sellers. These are investors who essentially bet that a stock will go down. Without getting too deep into the mechanics, here's the simple version. They borrow shares, sell them at today's higher price, wait for the crash, then buy them back at a lower price and pocket the difference. During a major crash, short sellers can make enormous amounts of real spendable cash while everyone else is watching their portfolios bleed. So when $1 trillion disappears from the market, a portion of that value does transfer to short sellers, to smart institutional buyers, to investors who hedged their positions correctly before everything fell apart. But the majority of what's lost, it was paper value, a collective belief about worth that the collective simply decided for a while had changed. And I want to be clear, this isn't me saying markets are fake or meaningless. This is just how they work. They're built on psychology just as much as they're built on numbers. There's a quote I love from John Maynard Keynes, one of the most influential economists of the last century. He described the stock market as a beauty contest, not one where you pick who's most beautiful, but one where you try to predict who everyone else will think is most beautiful. The price of a stock isn't just what you think it's worth. It's what you think everyone else will think it's worth tomorrow, which means markets are deeply, unavoidably human. They move on fear and greed and narrative just as much as they move on actual business fundamentals. And crashes? Crashes are often what happens when fear starts feeding on itself.
Here's the mindset shift that I think matters most, and I want you to really sit with this for a second. Understanding that most of the lost money in a crash is paper value, not actual cash that left your hands, doesn't make the pain disappear entirely. If you had $100,000 in your retirement account and it drops to $70,000, that still hurts, especially if you're close to retirement, especially if you were counting on that number, especially if you built that over years of disciplined saving and it feels like it just got cut down overnight. But understanding this changes the decision you're about to make. Because the most dangerous moment in a market crash isn't the crash itself. It's the moment you decide to sell. Think about it. Before the crash, you had paper value. During the crash, you still have paper value, just less of it temporarily. The second you sell, you've converted that temporary paper decrease into a permanent, real, locked-in loss. You've turned a fluctuation into a final outcome. And that's the part most people don't fully feel until months later, when the market has quietly climbed back up and they're still sitting on the sidelines, wondering what happened. And then, and this is the part that really stings, when the market recovers, as it historically always has, you're not in it anymore. You sold near the bottom. Maybe you bought back in near the top out of FOMO. And just like that, you've done the exact opposite of what actually builds wealth over time. You bought high, sold low, and told yourself you were being smart. I'm not saying this to make anyone feel bad. I'm saying it because this pattern is so common, so deeply human, that even professional fund managers fall into it. It's almost a physiological response to watching numbers fall. Your brain genuinely registers financial loss the same way it registers physical danger. The stress hormones are real. The urge to do something, anything, is overwhelming. Your nervous system is telling you to run. And in most areas of life, that instinct keeps you safe. But in investing, running is often the most expensive thing you can do. So the shift is this. When you understand that what's falling isn't cash in a vault, it's a collective belief, it becomes a little easier to hold on. Not because you're fearless or emotionally detached, but because you understand what you actually own. You own a share of real businesses, companies that employ real people, make real products, and generate real revenue. Some of them have been around for 50, 60, even 100 years. The price tag on your ownership stake can fluctuate, sometimes wildly, but the underlying reality of what you own doesn't vanish just because the stock price dropped on a Tuesday morning. And here's something worth thinking about. The people who have become genuinely wealthy through investing, not through luck, timing, or insider knowledge, tend to have one thing in common. They stayed boring. They didn't react to every headline. They didn't check their portfolios 3 times a day during a downturn. They had a plan, they trusted the plan, and they let time do the heavy lifting. That's not exciting. It doesn't make for a great story at a dinner party, but it works. And it works precisely because most people can't do it. Most people feel the fear, react to the fear, and lock in the loss. The ones who don't, the ones who just sit still and breathe, are the ones who come out the other side in a genuinely different financial position. Now, I know what some of you are thinking. That's easy to say when it's not your money falling. And you're right. It's always easier to stay calm in theory than it is in practice, which is exactly why the practical side matters so much. Because staying calm isn't just a mindset, it's something you have to prepare for and build the conditions for in advance. So what do you actually do with all of this? Because understanding the psychology is one thing, but you still have to live in the real world with real bills, real anxiety, and a real portfolio that sometimes looks pretty ugly on a Monday morning. So let's talk about what actually helps. The first thing, and this might sound almost too simple to be useful, is this. Stop checking your portfolio every single day during volatile periods. This isn't advice to be ignorant or uninformed. It's advice to protect your own psychology from itself. The more often you stare at falling numbers, the more your brain treats it like an emergency. And emergencies demand action. So you act. And usually that action costs you. Give yourself permission to check monthly, quarterly even. Your long-term strategy doesn't need to be renegotiated every time the market has a bad week. The number on the screen today is not the number that matters. The number 10 years from now, that's the one that matters. The second thing, have real cash you can actually live on outside of the market. An emergency fund, 3 to 6 months of genuine living expenses, isn't just a tip you've heard 100 times and tuned out. It's psychological armor. It's the thing that keeps you from being forced to sell at the worst possible moment. Because the only people who are truly cornered during a crash, the ones who have to sell even though they know they shouldn't, are the ones who went into it with no cushion, no options. When you have cash reserves sitting safely outside the market, a crash becomes something you can observe instead of something you're trapped inside. And that one shift changes everything about how you experience volatility. The third thing, zoom out. Seriously, just zoom out. Pull up any long-term chart of the S&P 500 and look at any crash in history. 2008, when the entire financial system felt like it was coming apart. March 2020, when the world shut down almost overnight and markets dropped 30% in weeks. The dot-com crash at the turn of the millennium. Every single one of those moments, the ones that felt like the end of something, now look like small dips on a long-term chart. Not because the pain wasn't real at the time. It absolutely was. People lost jobs, lost savings, lost sleep. But the recovery came. It always came. And the people who stayed in, who held on through the ugliest part, they captured that recovery. The people who left often didn't. The fourth thing, know what you own and why you own it. If you're in broad index funds, you own a tiny piece of hundreds or even thousands of companies at once. You're not betting on one business surviving. You're betting on the economy continuing to exist and grow over time. That's a very different kind of bet, a much more resilient one. And historically, it's been one of the most reliable long-term wealth-building tools available to ordinary people, not hedge funds, not billionaires, just regular people who showed up consistently and didn't panic.
None of this requires you to be a financial genius. It doesn't require you to understand derivatives, read quarterly earnings reports, or watch financial news for 3 hours a day. What it requires is patience, consistency, and just enough understanding of how the system works that you don't let fear make your decisions for you. Those things are simple, but simple is not the same as easy. And that gap between knowing what to do and actually doing it when everything feels uncertain, that's where most people's financial outcomes are decided. So let's bring it home. The fear you feel when the market drops, it's not weakness, it's not stupidity. It's a completely reasonable human response to uncertainty about your future, your family's security, and whether the plans you quietly built are going to hold together when things get hard. And that fear deserves to be taken seriously, not by running from it, but by building a financial life that's sturdy enough to hold steady through it. An emergency fund, a long-term perspective, a basic understanding of what paper value actually means. These aren't advanced strategies, they're the foundation. And most people who feel anxious about money are anxious precisely because that foundation hasn't been built yet. Not because they're bad with money, but because nobody ever sat down and explained this in a way that actually made sense. That's what we try to do here at WealthVault every single week. The $1 trillion that disappears in a crash, most of it is a reflection of collective belief, and belief, by its nature, can be restored. It has been restored every single time throughout the entire history of modern markets. Markets recover, economies rebuild, and the people who come through crashes the best aren't always the smartest or the luckiest. They're usually just the ones who stayed calm, stayed patient, and refused to let a bad Tuesday rewrite their entire financial plan. Progress beats perfection. Patience beats panic. And a little bit of honest understanding is one of the most valuable things you can bring to your financial life. I'm Mike. This is WealthVault. If this video helped you see things a little differently today, go ahead and hit that like button. It genuinely helps this channel reach more people who need to hear this. If you're not subscribed yet, now's a great time to do that. We talk about money, psychology, and the stuff nobody explains clearly every single week right here. And drop a comment below and tell me, what do you actually do when the market starts crashing? Do you check obsessively, or do you log off and go touch grass? I genuinely want to know. I read every single comment. I'll see you in the next one. Take care of yourself.